I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Ballara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you. Hi everyone, I'm Jason Ballara and this is the Know Your Why podcast. Today I'm here with Veena Jetti. Veena is the founding partner of Vive Funds, a unique commercial real estate firm that specializes in curating conservative opportunities for investors. We were talking a little bit before we started recording. I sort of feel like, even though this is the first time we're meeting, and by the way, thank you so much for doing this. I do feel a little bit like I know you from from other avenues, but I would love it if you would kind of just give us your background, tell us your story, kind of where you came from and where you are today, which I think that there's really a lot there. So I'm excited.
Yeah, I'm really excited to be here and happy to finally meet. So thank you for having me. Like you said, I'm Veena Jetti. I founded a company called Vive Funds. We focus on large value add multifamily in the Sun Belt. And one of the things that I would also say is we target those more conservative assets. We like to go into those really vanilla deals. And we look at units that are 200 units and up with a strong preference to 300 and 400 unit plus deals. I started it, so I took the shortcut in, right? Because I come from a real estate family. My mom is actually a really successful real estate investor. Now her and my dad are completely divested and retired, and they're purely LPs into my deals. So they do no more active management of their assets anymore. And so we look to continue what my family's principles kind of were, to be more conservative and make sure that we are leveraging correctly. And so graduated when I was 20, went and worked at some of the best real estate shops in the world, and ultimately decided that I needed to go out on my own. It's just more tax efficient. And so started my own company, and here I am today.
So that's awesome. It's funny because most people I've talked to on the podcast, that, it's like they're coming from some totally unrelated field. Maybe they had a parent who was a contractor. Maybe their parents had a duplex or something. But your family like legitimately came from real estate investing. So that's pretty cool. And actually, I think worth talking about, because I don't, like I said, it's not kind of the norm. And so as you're growing up and you're going through, sort of seeing them, what kind of investing were they doing? What did it look like to you? Or did you just know it was going on and you just kind of, picked it up after college? How did that work?
So from a young age, they actually included me. Like, they made my sister and I go to closings and walkthroughs, and they made us do all this boring stuff at the time. And I'm going to age myself, but there were no iPads and smartphones. So we had to go to closing and listen to them talk and wait. And, we had our coloring books, and we had, our regular books that we checked out from the library. And so we grew up around it. My parents never shielded us from the business from a very young age. They started including both my sister and I. My sister's a minority partner in the company now too. So we both kind of ended up in this space, mainly because I think it's just, one, it's a very tax efficient investment. And so I think that that's great. I specifically chose multifamily, where my family did residential, but we chose multifamily because it's very scalable. And I think that there's less volatility in the multifamily market as well, which is, great, and goes to our conservative nature. So that's how we got here.
Sure. That's it's very, it's very cool. I think, and you have kids, right?
I do. I have two and a half year old twin daughters.
And I have a 3-year-old and a 10-month-old. So, but I hear that. I hear what your parents did, bringing you to these things. And I'm actually very excited for when my kids get even just a little bit older, to have them be a part of that. And it's just fine. You don't have to be in the business necessarily, do whatever they want, but just seeing the power of it and kind of getting them involved at a young age, I think
it obviously sets you up for a lot of success. And so you're a prime example of that. And most people are coming from that, oh, I was a engineer or a whatever, some other job, and they're like, field, I just decided to switch careers. So that's pretty cool. So when you started Vive Funds and you were sort of building the business, maybe walk us through some of that process, because I think that's a hard thing for a lot of people, the starting the business, treating it as a business, building a team, that kind of thing. Talk to us about that a little bit, how you've done it.
Yeah, I wish I could say I have like the secret sauce, but I feel like I'm still figuring it out too, right? Because every time we do a deal and every time we exit a deal, we always learn something new along the way. One of the things that I really focus on in the business is learning from other sponsors or even other business owners, even if they're not even in real estate. I like to see if there's principles we can adapt from someone who runs a restaurant or somebody who owns a laundromat, to see kind of how they're operating their business, what they've found to be useful. But I would say anybody who wants to start, one of the biggest mistakes I made that I wish I would have done and a little more diligently, because it's much harder retroactively, is ensuring you're setting up systems and processes to deal with scale ahead of time, right? So initially it might seem like, okay, I don't really need to invest into some kind of a CRM, right? I can keep it all in an Excel spreadsheet, or I can remember all 10 people I've talked to. But the reality is that's not a scalable model. So you want to invest into those systems and those processes out of the gate, so that you're not trying to retroactively install them and get everybody used to them and get everybody's buy-in and get on board with them. So I wish I would have invested more upfront on this software and the systems and the processes, and invested the time into developing those, because you just get more busy as time goes on. I had a lot more time years ago to develop these things. And now it's like, all right, I have to miss this family function so that I can make sure that this system gets set up. So next time we're not dealing with the same thing again.
Right. Yeah. And I think that's maybe a common theme from people that are experienced, and they're like, but when you're starting out and you're kind of in the thick of it,
yes,
there's so much going on, and you're like, I can't take a week to set this system up, or even, I can't take an hour to set this system up. It's kind of, but yeah, that's, use the sort of 10 person, I've talked to 10 people. That's kind of how it starts out. But at this point, you're talking to hundreds, if not thousands of investors and, institutional investors and things. So you better be on your game and know who you're talking to, know what,
absolutely,
because you're looking for, sort of bigger capital contribution. So it makes total sense. It's one of those things that it's like, yes, of course, but then
you have to actually do it.
Yeah. Right, yeah. It's like, I should definitely do this. And then it's like, so many things keep coming up. When we talk about, syndication and things like that, there's obviously different hats that people wear, the deal finder, the asset manager, capital raiser, those sort of things. What do you do? Are you sort of doing it all? Do you have a specific thing that you like to focus on? Kind of what's your niche?
Yeah, so I have been JVing with Ellie Perlman from Blue Lake Capital, whom you know, and she's been amazing to work with. And both of our companies could run a deal cradle to grave independently, but there's a lot of power in our partnership because we are now redundant, right? So if she has to step out for some reason, or I have to step out for some reason, we can always come in and kind of cover each other, and it's a seamless process. Investors have no idea who is doing what on any given day, right? Because our teams integrate very seamlessly. So with that, my favorite parts of the deal, and I do a lot of things I don't love doing, but my favorite parts of the deal that I do touch. So I typically will handle due diligence in the acquisition phase. I touch the capital stack pretty significantly on the equity side. So I do a lot of the investor facing, anything that is legal for the most part. I do the legal and kind of the tax strategy. So I work with our attorneys, I work with our tax professionals as needed to make sure that we get everything, squared away, that the SEC filings are done correctly, et cetera. And then anything, on the post-close operations, anything external facing to investors. So when you get your distributions, it's our team that is overseeing that. We're
always
the one
on time.
I try really hard.
Firsthand experience, they always come on time. So yeah, that's
yeah. I try to set it up like, so it's clockwork. It cuts down on the questions because then no investor, if investors don't see it by X date every month, then they reach out to me and they're like, hey, where's my distribution? I can go search for it instead of, making it this way or that way. Then I'll have investors asking me just randomly. So it streamlines the process. Investors are happy. That's what our goal is. So.
Yeah. Well, great. I do think, certainly power in partnerships and the two of you are absolutely powerhouse in the space. And I like being an investor. I like, I did my mentorship with Ellie, and I just like seeing what you're doing, because it's always, for me, it's like, silly, but like hashtag goals. This is where I want to build to get to that point of just, what you guys are doing in scale and how well it's run. So it's fantastic. So since you're focused on due diligence, let's talk about that. Kind of what's your process? What are you kind of really narrowed in on as you're looking at these deals?
Yeah. So I have like, you don't even want to know. I have like a 53-point checklist that I use for our deals. So usually it's kind of nuanced, right? Because it has to also align with the PSA and what they've agreed to give you in due diligence. And sometimes you can like squeeze in a couple more documents depending on who the seller is and the rapport there. But so when we start our due diligence process, a vast majority of it happens before we even make an offer on the deal, right? So we are verifying comps, we're pulling data, we're looking at our AI softwares to see where they're projecting out. But then once we start the physical due diligence, I usually head out to the asset on day one and I stay through the due diligence process. I'll typically walk, a good percentage of the units just to kind of get a feel for what's going on inside. It's a really great opportunity also for me to talk to the tenants on the asset, kind of see what they like, what they don't like, what they wish there was there, what current management is doing correctly or incorrectly. It also gives me a really good opportunity to review lease audits. So I get an opportunity to deep dive and see who are our tenants. How can we make this a better community for them? How can we get the good tenants to refer their friends and family to come live here? So those are more, I think, integrated with due diligence and like the strategic operations side. And then, just learning, like I shared with you a couple of things that we learned when we were actually walking the asset that we wouldn't have known. It would have never come up in paperwork. And so those are the things we look for in due diligence primarily. And then of course you have, your financial reviews and audits, and you're making sure everything is ticking and tying. All of your permits are in place, your life and safety, everything is in place. So, and then we also track the status of the asset through the acquisition process to make sure that, we're not under contract and then all of a sudden there's double the amount of evictions or the NOI drops by 20% or something like that. So we kind of keep a finger on the pulse to see, what's happening and how it's operating.
And that actually brings up a good point relevant to a deal I'm currently looking at. When you say that, do you put that in your contracts? Is that in your PSA that sustaining some level of occupancy and rent collections, things like that? Is that something you sort of put in there as an out clause?
Not an out clause, but we do make them agree to continue operating within reason. Now, depending on the asset that you're looking at, in other deals that we've done before, I've negotiated in, it has to be, if you want to move rents less than X amount of dollars above current rent, or if you want to decrease the rent, you need approval from us as the buyer. Yep. That just ensures, especially if occupancy has maybe been a historical issue, what you don't want them doing is going in and just leasing it up to unqualified tenants. So you can set those metrics and say, if you want to go outside of this, no problem, but you need approval from us first as the buyer. Because what you don't want to do is inherit the property with tenants that you now have to deal with and your lending isn't happy about.
Yeah, makes total sense. Just, sort of protecting yourself on the back end, that you don't come to the closing table or worse yet, after you've closed, you get over there and find out that things are not what you anticipated. When you're doing your due diligence, I assume that's when you're kind of forming the business plan for the value add strategy at that point. Or do you
Not
do it?
quite. We do
Okay.
that beforehand.
Okay.
So before the LOI even goes out, we have a good idea of what the market is doing, what we can do in this asset. We know where generally the highlights of the business plan are. Now, once we get to LOI phase, we'll kind of drill down a little bit deeper. So we might look at, okay, we were planning on just doing flooring and stainless steel, but now that we see what the market is doing, we've seen the asset, we think it looks beautiful, but we really need an extra, coat of paint on the outside or the exterior, right?
Mhm.
So those are things that we might decide a little bit later in, but generally we already know where our value add is coming from. We know what our post-renovated rents will be. We know what the tenant base is like. So we've done a lot of due diligence by the time we've gone into it.
Okay, great. Yeah. So essentially then you're using those walkthroughs and to really just to look for surprises.
Yeah, that's what it is. It's like trust but verify. So we're
Right.
just verifying that they're correct on what they're telling us and that everything matches to what we're seeing in the numbers and the financials.
Okay. I don't know that I've ever asked anyone about this before, but I think it's relevant to what's happening today in the debt side of things.
Mhm.
What are you seeing, kind of what are your thoughts in terms of, and I'm sure people here are all hearing, even not in the space, interest rates are rising, interest rates are rising. What are you seeing? What are you doing to sort of maybe account for, combat that? You can't really combat the interest rate hikes, but to kind of incorporate that in your business plan.
Yeah, we mitigate that risk. So one, yes, interest rates are rising. It's not really a surprise to anyone. The Fed's told us very clearly that they're going to be raising rates. They've been doing it. We're already seeing it baked into our pricing now. So one of the biggest thing that we're doing is we're buying rate caps, and we're spending more money on rate caps than we have historically, to ensure that the rate cap can't adjust above whatever the cap is, right? So the interest rate can't adjust above whatever the rate cap we buy is. So that's number one. Number two, we're leveraging a little bit less. So we're entering an asset, for example, right now, where we're leveraging at 65%, which is about 10% less than we normally would. The challenge there is when you bring more equity to a deal, typically you see a constraint on cash flow during the hold period because now you're paying out more equity. But the trade-off makes sense, at least in my opinion, because it's more conservative for investors and it protects them from downside. So as of right now, at this point in the market cycle, we are protecting downside. We're not chasing upside. We'll protect downside and let the upside take care of itself. So I think being really true to those metrics, not changing numbers to make the deal work. If you put garbage in, you'll get garbage out. So continue making sure that you are staying true to who you are as a sponsor, what you believe to be actually conservative is. And then lastly, one of the biggest misses I see on new investors, especially right now, is there's no trend upward of interest rates over time on an adjustable rate or a bridge product. So if you're going in today and you have let's say it's 3.5% is your rate today, you'll want to trend that upward toward your cap or all the way up to your cap over the next 6 months, year, 2 years. So you're baking in that change. And then also same thing with insurance and taxes to make sure that you're allocating high enough for that, because otherwise you'll run into an issue with cash flow.
Yeah. All of those expenses, even from a year ago, 2 years ago, were sort of dramatically higher. And those are the big ones. Those are the big line items. So
right.
Makes a ton of sense to just, if you're truly being conservative, then be conservative and realize that those numbers are very likely to go up.
Yeah.
So once you get a deal under contract and you've got your property management in place and everything like that, what does that look like to you? How do you guys work that, relationship with the property management group? I know it's typical to have, sort of meetings and things like that, but as a team that has, been very successful, had very large deals, what are you doing? What are some of the tips and tricks that you use?
As it relates to property management, we are very, very hands-on asset managers. So on our deals, Ellie and I are constantly tracking the progress of the asset. We both have eyes on the asset. If there's any deviation from our business plan or any deviation from the cash flow that we're expecting in a month, one or both of us jumps in, or we're talking about it and strategizing around like, hey, what should we be doing? What's going wrong? How can we course correct back? Because what happens is if you start to veer off course just a little bit over the course of 5 years, you're really far off path. So you have to kind of catch it and then course correct back onto course right away. And so we're just very, very active and hands-on asset managers. We'll show up and we'll surprise the property when one of us goes out there so they know that we're not hands-off owners. We're not going to just turn it over to them and let them run wild and free. We also make sure that we train them to think like owners right when we get in there, right? So when you have property management and it's fee managed, what usually happens is they want to keep enough cash back to pay future bills, which is great. And, from a personal finance standpoint, we're like, oh, okay, that's good. You should have enough to pay your bills. But what happens when you're operating an asset is you're only accounting for future bills, but you're not taking into account the future income. So you have to take in the AR alongside the AP if you're going to handle it that way. So we actually really focus above like NOI, occupancy, all of that. We actually focus at the free cash flow level. So what is my cash flow available at the end of every month to investors? Because I have to make my distributions on time. So I need to know what that number is, and I need to know that that's what we're tracking to. So we kind of really drive the focus there versus just occupancy, NOI, lease renewal, stuff like that. We want to see the total dollars out of the account.
Yeah, I mean, that makes a lot of sense. Ultimately, as a sponsor, if you're doing it right, your commitment or your goal is to make your investors happy, to get those distributions out. And so if you look at it from that perspective, then that cash flow tracking is 100% where you should be looking. That makes a ton of sense.
Yep.
That's great. I'm sure there's so many so many tips and tricks that you have to all of this that would be super helpful to people. I will so I don't keep you all day, I will switch gears here to the part where we will ask you the questions that I like to ask each guest.
Okay.
The first one is related to the name of the show being Know Your Why. So, what is your why? What pushes you towards this level of success and keeps you going?
My family, my girls, I have daughters, and it's really important to me that they see women in positions that are historically male dominated. And so it's important that they have role models that they can look up to. And I always tease Ellie, I'm like, I'm going to send my girls to come and work for Ellie auntie because she's going to be much meaner than mama will be. So, but yeah, my kids are absolutely my why, my husband, my family.
Yeah. I can relate. Tell us something about yourself that maybe isn't common knowledge, maybe a special skill or a hobby or something that you don't mind sharing.
Oh man, I was just on Ellie's podcast and I told her one that I never shared before, and she was totally shocked by it. But I told her I can speak Pig Latin fluently. And that is because when my sister and I were little, we had to think of a way to speak around my parents so they couldn't understand us. And so we learned how to speak Pig Latin.
That's amazing, and also kind of amazing to me that she didn't know that wouldn't be a thing that came up along the way. That's very funny.
Yeah, I can't imagine why it didn't come up.
Yeah. Kind of on that note, maybe let's just talk about Clubhouse a little bit. We talked a little bit before we started recording. I know you're very active. Obviously people use social media. It's a big part of business. It's a big part of, sort of getting yourself out there and known. How do you feel that Clubhouse has helped you in terms of your business, maybe attracting investors, all of that? What's your take on that?
Yeah, I actually don't get that many like new investors from Clubhouse. A lot of times it's my current investors that just want to hear like what we're seeing in the market or how we're thinking of things right now. They just kind of want to keep that open line of communication or information flowing. Really, the reason I stay on Clubhouse is because I feel like it's such a powerful tool to be able to believe that we have to help other people that are trying to do what we're doing or who are just starting out. And so it's the only way for them to get that kind of access, because they might not be in a room with me at any time in their lives. And so I like to keep that access open, but also limited to just like one area of my life, so it doesn't overwhelm me. And then two, I learn from other operators, other sponsors, other business owners, how they're operating their business, and about new products or new trends or things we can do better or new markets they're entering. So I like to kind of see what the people are doing.
Yeah. Well, and it maybe it doesn't get you a lot of new investors, but if your current investors are listening and hearing you sort of put out your expertise in these rooms on Clubhouse, it probably impacts them as to whether or not they want to reinvest. So now they're getting to know you better. They're seeing, okay, great. The properties are performing well, which is obviously very important, but also she really knows what she's talking about, and they can listen and kind of, get a little peek into that side of you. So that's pretty cool. When people hear this, how can they reach out to you?
Yeah, you can find me on my website, vivefunds.com, VIVEFUNDS.com, or I'm on all the social media as Veena Jetti. So you can find me on social media as well.
Perfect. Final question, Veena. What piece of advice would you give to someone who is getting started and sort of looking to achieve that level of success that you have?
Oh gosh, there's like so many things I would do differently if I could go back and tell younger me. I think the big one for right now, where we are in the market cycle, is just be patient. Do not be aggressive in your assumptions. If you do one deal that is not a great deal or a good deal, or that doesn't end up okay, you're going to have a very short career. So make sure you're choosing your investments right. Be quick to say no, be slow to say yes. Take your time, really understand the numbers and how they all work with each other, especially if you're raising other people's capital. It's a huge responsibility and it's a huge undertaking. And you want to make sure that you're treating them the way you would want to be treated if your hard-earned dollars were in an asset. So, for us, everything starts and stops with how LPs will be treated, what their returns will be, what their experience is like. And so keeping LP investors at the focus has actually led to a high reinvestment rate. It's led to our investors being happy. They refer their friends and family to us, which is the highest compliment we could expect.
Yeah, absolutely. No, I think that's a fantastic piece of advice. And I think it's actually encouraging that you started that with, oh, there's so many things I would have done differently, mistakes I made, and yet still you're extremely successful. So it goes to show, it's okay. You can make a mistake here or there and still recover from that and still have a great career. So it's great. Thank you so much. I really appreciate you coming on. I appreciate your time. It's been fantastic.
Of course. Thank you for having me.
Absolutely. All right. We'll go ahead and sign off. Have a great day, everyone.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Ballara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.